Hello everyone. So today we are going to talk about a new topic, which is your spot rate and forward rate. So again, this topic is very important from the examination point of view. You should be aware that what is the exact difference between a spot rate and forward rate. So at the end of this class, this session, you will be able to have a good understanding of what is the difference between spot and forward rate, and why are we calculating the forward rate, what is its significance. So all those things will be clear to you, right? So let's begin. So the spot rate is nothing but the currency rate at which buying and selling of the currency happens on the spot. When I say on the spot, that means right now. Okay, suppose someone has to buy a certain currency. Suppose if you are an Indian, you need to buy USD. So you go to the bank or a dealer to ask the prices. So he quotes a price, right? So that price will be known as spot rate, right? So spot rate is nothing but the on the spot rate that is conveyed to you by the bank or the dealer, those who are dealing in the currency market, right? Now, what is the forward rate? Forward rate is the currency rate agreed today. This is very important. This has to be written in the examination. The currency rate is the agreed today between parties at which buying and selling of currency will happen at a future specified date. Okay. So this forward rate is totally dependent over spot rate. There's a formula that we will be studying very soon, because forward rate is something that is dependent on other factors also. One of the factors is your spot rate. The other factors would be your interest rate of both the countries in which we are dealing with the currencies. Okay, so what is the prevailing interest rate in one country and the other country? Because we already know that currencies, they trade in pairs, right? So two countries are involved, two currencies are involved. So what is the prevailing interest rate in both the countries? So that would be one of the factors. Then again, the other factor will be your inflation rate and the trade balances, and many other factors are there. Apart from that, supply and demand of the currency, particular currency, that also affects the forward rate, right? So basically, this particular concept of forward rate we are studying because tomorrow if you go to the corporate and you start working in the financial department, so if some company is dealing with the import and export with the other countries, so currency fluctuations that impacts a lot to the revenue of the company, right? So we have already studied the concepts of appreciation and depreciation of the currencies. So that's a continuous process. But have you ever thought that this appreciation and depreciation will be a kind of very smooth in coming future? The answer is no, right? There are like a lot of factors which are playing in the market, like supply and demand, interest factors, interest rate factors, your inflation factors. So the forward rate, the future rates could be anything, right? It can be significantly more than what you are expecting after 3 months, right? So all those risks are there. So you need to have a sound understanding of what could be the right forward rate in the future. So basically, this is the currency rate agreed today between parties at which buying and selling of currencies will happen at a future specified date. Okay. Now, understand this with an example. I hope you are clear with the spot rate. I understand that there is something which would be going on in your mind, that future or the forward rate is not clear. So we'll be trying to understand this concept through an example. Suppose there is a company called ABC. This company is a crude oil importer, right? Suppose this company is into India, right? They are importing the crude oil from US. Okay, so US is the exporter of the crude oil and India is the importer of the crude oil, right? Suppose now this particular company is taking the crude oil on credit, right? Then this company will have to pay the money for that crude oil. But since it is getting that particular oil on credit, they need to pay this money after 3 months, right? But since the exporter is in US, so they would be demanding the money in US currency, right? In United States dollars. But then again, since this company is working in India, they have to pay the supplier which is there, which is stationed in US. So again, two currencies comes into play, that is your Indian rupees and the United States dollar, right? So you never know that what could be the scenario after 3 months, right? You never know that what would be the currency exchange rate between these two countries after 3 months, right? So it can be significantly more than that what you are expecting today, right? So to do that, to mitigate that particular risk, this particular company ABC, they reach out to the bank or the dealer, right? For what? To buy 1000 USD after 3 months at a rate agreed today, right? They go to the bank and say, okay, today we will come into a deal, right? Wherein the deal is that I will be buying 1000 USD, 1000 USD after 3 months, right? At a specified price. So price will be decided today, and everything will be decided today, that what price I'll be giving to you in exchange for the dollars after 3 months. I hope you are now clear about what is happening over here. Why this thing is happening? To understand that better, read this particular para which is there on this screen. So company ABC, it's a crude oil importer, need to pay supplier in USD after 3 months. But ABC is worried if USD appreciates abruptly beyond a certain level, he will end up paying more to the supplier after 3 months, right? So suppose ABC is expecting that since today the spot rate is somewhere 82 INR for 1 USD. So after 3 months, it should be near about 83.5, right? So 83.5 is okay for the importer, that company ABC. But it is not certain that it will be at 83.5, right? Because of the supply and demand and the interest rate fluctuations, it could be 85, right? So that is what ABC company is worried about, because if after 3 months the prices becomes 85 or more than that, 86, then company ABC will have to pay more for $1, right? So that is the risk which the company ABC has today, right? So to avoid that situation, he will enter into a forward contract today itself with the bank or dealer to seal the price of USD after 3 months. This is also known as hedging. Let there be any exchange rate after 3 months, the importer will only pay the exchange rate decided 3 months before with the dealer or the bank, right? So we'll understand this better, like how to find the right forward rate today itself, that you are going to get into agreement with the banks and the dealers. That also you should be aware of as a financial manager, right? So I'm taking one scenario only. When interest rate is given, then how do you calculate the forward rate? So the formula would be, your forward rate is equal to spot rate into 1 plus interest rate of the price currency country divided by 1 plus interest rate of base currency country, right? So suppose this is the spot rate today, that means 82.000 INR for 1 USD is the present spot rate, right? So can we write this in this particular pattern, 82.0000 INR oblique USD. Here the price currency is Indian rupees and the base currency is USD. Suppose we need to find out what could be the actual price, actual rate of this particular currency after 3 months. So that is what we are looking for, the forward rate of this particular pair after 3 months. Okay, so this is the scenario which is given. Like suppose in India the interest rate is 3% per annum. Per annum means in a year there are 12 months, so per year the interest rate is 3% in India, and in US the interest rate is 2% per annum. So we need to calculate the 3-month forward rate of Indian rupees and USD. Presently the spot rate is 82.0000. So what could be the forward rate of this particular pair of currency after 3 months? So that we need to find it out. So we have the formula over here. We need to put all the values in the formula to calculate. So in place of spot rate we put 82.000. In place of interest rate of price currency country what is your price currency country? It is your India, right? INR. So what is the interest rate in India? It is 3%. That will be writing. And since we are looking for the forward rate after 3 months, so that is why we have divided 3 by 12, because the rate is the annual rate. So we need to convert this rate for 3 months. So the rate will be 3% into 3 divided by 12. Similarly, we need to convert this US interest rate, that is your base currency, for 3-month rate, right? So this is how you convert this, and finally you get the price like forward rate after 3 months. It would be 82.2039. So I hope you understood the concept of like how to calculate the forward rate once you have spot rate and the interest rate of both the countries, right? So with this, suppose this is the forward rate which you have. Now you go to the bank and you ask them that this is the price at which I want to get into the agreement today with you, that after 3 months I'll be paying this price for 1000 units of USD. So are you ready? So it totally depends over the banker or the dealer to get agreed with you to enter into the contract at this price, because they will also calculate seeing the different factors. So if they are ready and as per your rate, as per your calculation, then you will enter into a forward rate agreement, forward rate contract, right? So what would happen? What is the benefit of this? Let there be any price after 3 months. Suppose the prices goes up to 86, but you will still need to pay only 82.2039 for 1 USD. So you will be actually stopping the unnecessarily risk because of the price fluctuations that could happen, that could hamper the revenue of the company. So that is the benefit of the hedging. So that is the benefit of this forward rate calculation that you understood. So I wanted to give you certain definitions of forward exchange contracts. So this is the definition of forward exchange contract. Is an agreement between two parties to effect a currency transactions, usually involving a currency pair not readily accessible on Forex market. Okay, so this forward rate agreement that happens over the counter with customizable terms and conditions. Customizable terms and conditions means this will be mutually agreed by both the parties, like what would be the contract size, when this will be executed, like after 2 months or after 3 months or after 4 months. So based on the requirement of both the parties, it can be customized. The lot size can be decided, like what would be the size of the contract, like 1000 units or 2000 units or 3000 units of USD will be bought and sold. So all those factors are mutually decided. So that is why this customizable term has been used over here, many times referencing currencies that are illiquid, blocked or inconvertible. Okay, now this forward exchange contracts are used as a hedge against risk, as it protects both the parties from unexpected or adverse movement. So that is what I was talking about. The adverse movement means because of the supply and demand, interest rate fluctuations, your inflation rate, prices could appreciate or depreciate significantly. So that could that can create a kind of risk for any of the party, right? So through forward rates we enter into a contract to hedge the risk that can potentially save the company from the unnecessarily losses that could happen because of the currency fluctuation, right? So in the currency future spot rates when forex trading is otherwise unavailable. So this is what I needed to talk about today about the spot and forward rates. Apart from that, we also studied the how to calculate the forward rates if you have a spot rate and the interest rate of both the countries. So if you still get any kind of doubt, I strongly suggest that see my previous videos for the concepts like price currency, the base currency, then what is direct quote, what is indirect quote, because until and unless those concepts are not clear, you will not be able to understand this particular concept which we studied just now. Apart from that, there is another video on appreciation and depreciation of currencies that also you need to understand. So please go through that videos before seeing this video. Once you are done with those videos, come again and see this video, so the concepts will be more clear to you. In examination, this particular topic will be tested. Again, you will be asked to calculate the forward rate based on the spot rate and interest rate of both the currencies, both the countries. So prepare well. If you still get any kind of doubt, please let me know through comments, or you can directly contact to me. So thank you so much. Have a nice day.